Welcome to Are You Down with LPT? I'm Kyle Clarkson, and we're here with Matt Nolan from New American Funding. Matt, how you doing?
Thank you very much for having me, Kyle. I'm doing great. How you doing today?
I was laughing at myself right there because I said funding, like it's it's some slang.
Well, it's past tense. I like it.
We're done.
We're done.
The funding is done. Yeah. So appreciate you joining us. Want to learn a little more about you and just talk through our company, kind of who you are and kind of what you do here. And so maybe before we do that, maybe tell us a little about your past and what you did before you jumped into the whole lending thing.
Sure. Well, so I've always been in lending, but money's money. But I started off my career with Chrysler Financial back here in Des Moines, and I was all different roles with Chrysler Financial. So I started off as an auditor and a couple other positions, but that moved me around quite a bit from Des Moines to Detroit to Milwaukee to Syracuse, New York.
Oh, wow. Where are you from?
Des Moines originally.
Oh, yeah. So you were in the car industry, huh?
I was in the car industry.
You got that little
car guy sales. Yeah. I got some extra watches too. So, but it was. So I've always been on the lending side in consumer lending. And then I was in Syracuse, New York, and 9/11 happened, and I kind of wanted to get back to the Midwest, and had both the kids out in New York, and so made it back to Des Moines, and worked with Chase Manhattan Bank for a little bit, and then it was shortly after the 08 crisis that I jumped into mortgage lending, which is I guess when everybody's going one direction, you go to the other direction. I guess
makes sense. Everybody's leaving, you jump in.
So I've been doing it for a while, probably not as long as some my age, but I had always been in lending though. So I think when I first started off, I had a pretty good book of business, but then I got into the management side of things. And
where was that?
Various different companies, but it was the same place. We just had different affiliations. Finance of America was the last company, but I worked my way up through, and we had was the branch manager with Finance of America, and we probably had about 40 or so loan officers in multiple states.
So go back to the car sales or finance. Talk about that transition. I mean, is it way different? Is it similar? I mean, I'm sure some of that stuff prepared you for what you're doing today.
Yeah. So obviously lending is lending. I mean, credit reports are when I started in the auto finance, they really didn't have credit bureaus. So it's a couple of years ago. So, but. It is lending. Money's money. Car business is you're still these days you're still financing 60, 70, 80,000
small houses.
Yeah, small houses. But obviously the paperwork is a lot easier. You can go in on a Saturday afternoon and walk out with keys and to have the money. So I guess the biggest transition between the two of them is the buying process on a home. Is about the 25 to 45 day range versus a car is. Maybe from noon to 2. So it's a little bit different in the timing aspect of it, but you're still dealing with money and people's ability to repay, I guess.
So you got an 08, which you feel like an idiot to get into real estate in 08, but congrats.
My decision-making skills have been questioned a few times, but yeah.
I kept trying to get out in 08, but I couldn't find a way out. But anyway, glad you didn't. Glad you're here today. So changes from 08 to today, there's been quite a bit. What are some of the changes you've seen in this industry in the last 17 years?
Well, I think some assimilation or some standardization on a lot of the forms. I think everyone kind of understands that we had the Altas and everyone had a little bit different documentation. When they switched to the CFPB, rolled out the loan estimate and the closing disclosure statement, it had a lot of continuity to the flow of the documentation. Now, obviously, everyone can say there was a lot of bad things that came of it, and there's a lot more regulation. Mm-hmm. But I think we could all agree from 08 till now, there needed to be a change.
We're better off. Yeah. We're better off for it. We always had that saying, if you could fog up a mirror, you get a loan back in 07, 08, back in that range.
Yeah. So not all the changes were great, but I think we've evolved, and there is a lot of documentation to it. But I think you go with somebody that's seasoned, that kind of been through it a little bit, and they kind of understand the nuances of the new regulations, or at least they're not new anymore. It's just the regulations, I guess.
So 17 years, a long time, and obviously a lot of changes and all that. How have you seen your growth of those 17 years? Or maybe a better question is, like, how do you continue to grow? You've had success. You're here. If you're here 17 years later, obviously you've been successful in it. And so, what are some of the keys, and how do you continue to grow?
Well, I mean, I think you keep continue to evolve. So, when I started in 08, I was a loan officer, and I originated and, had a decent book of business. And, as I evolved a little bit, though, I got into the management side of things. And so, back in, I don't know if it was 2012, 13, somewhere that range, I became a branch manager for Finance of America. And we had roughly, I don't know, it was probably about 14, 15 states that we covered. So I had about 40 or so loan officers reporting back to me. So I kind of got out of the origination piece of it. And over those years, what it kind of taught me is if you don't mess up a deal from the very beginning, sometimes it's easier not to fix a problem if you didn't have a problem to begin with. So I think I evolved and I want to get back into the lending space. So back in 2018-19 time period, I joined Lincoln Savings Bank. And got the opportunity to sit within a real estate office and made some great relationships.
I'm guessing that managing side probably taught you quite a bit too, or prepared you for getting back into it.
It did. I mean, but I will tell you, it's a bridge that's tough to cross, because once you get in the management side, you lose all your contacts, and people do business with people they know and trust, and
had to build it back up.
Yeah. So even though you're handling all the problems that pop up, you lose those first connections, and you had to rebuild those. So
I told you I tried to get out of real estate in 08, and I got fortunate I didn't, but instead I took a job as an education director, because those that can't do teach. And so that's what I did for 3 years. But it was in that time when I really began to learn the business, and that did more for my career than anything. And then when I got back into the selling side, I learned so much in the 3 years of teaching that I was ready for it. And I'm guessing you had probably learned some things in management, at least, that kind of pushed you when you were ready to start back on the lending side, right?
Yeah, I mean, I think you hit the nail on the head. I mean, when you handle 40 some odd loan officers, and every problem that comes up goes through your desk, and so you're dealing with underwriters, you're dealing with Fannie Mae, Freddie Mac, appraisers. You handle all the bad stuff that comes up. It puts some gray hairs, and I got every one of them, honestly, I believe. And
that's why we don't use this for video.
It's a good thing. It's a good thing. But so you do. I think I'm very seasoned as far as what I've seen and what experiences I've had. But you still need to have the firsthand knowledge of being in the conversation when somebody's looking for a loan.
Yeah, I think I didn't know that management piece about you, but like how beneficial for you today to have gone through all of those bad files,
right?
So to be able to work them today for your clients. So, go ahead.
Well, and I think that's where it was a great fit. So when I went to the real estate office, I had all the experience, and I had been a part of a lot of different scenarios. And the office I went into had a lot of seasoned people, and
This is 18.
This is 18-19 time period, yeah. And with seasoned realtors, they've seen a lot of things too. Yeah. But and they needed somebody with experience, and didn't want to have a newbie in there, and it was a great fit, I think.
Yeah. Did it take you long to develop those relationships within the office, or did just? I mean, you're natural at developing relationships. I can tell that, but for them, the agents to gain trust with you, did that take long? Was it something you had to build over time? I think
it did. I mean, I think the older we all are, the more guarded we are with our referrals. I see that on a day-to-day basis. I don't expect to show up and expect somebody to give me, if somebody's closing a $500,000 loan, I mean, they know this person in and out, and I'm asking them to trust me with their clients. So I don't want it to be an overnight conversation and them just trusting me 100% because, they'll probably go someplace else in a week from now because the next flavor of the day. So it does take a while to build that rapport and you see the good and the bad through the whole thing. And I think it's important to build those relationships over time. And I think I've done that very well. So
yeah, and so we partner with New American Funding. Thankful for that partnership. I think those relationships that you began to develop 6 years ago, you can correct me if I'm wrong, but that's probably how we connected, right? Yes. And how you ended up over here in our Clive office. Is that safe to say?
Yeah, it's very safe to say. I mean, it was the number one reason I came over is, well, and obviously Kyle, of course, but yeah. We had a meeting at Starbucks coffee, and
86th Street.
He wooed me with his sales pitch. No, it was a great conversation. But I do think that those relationships, what brought me here is I wanted to keep those relationships, and they wanted to keep a relationship with me. So it all worked out.
So not to build you up here. Obviously, you do a good job. These agents trust you. But what do you think are some of the things the reasons they trust you? What sets you apart?
So I think the most important thing is we kind of just talking about different things to talk about on the call here was or the conference here.
This podcast.
Podcast. That's those fancy words or whatever. But
those gray hairs are showing.
Exactly. When I look at it is I want to work as hard as the agents are working. Because I'm a banker, I'm not a 9-to-5 guy that is going to be gone at 4 o'clock on a Friday afternoon. I think a lot of realtors get a bad name because people see realtors out, for lunch or this during the week, but they don't see the realtors working unless they're working directly with them at 8 o'clock at night on a Saturday, where everybody else is out getting a drink on at the local pub or whatever. So I think what I find helps me continue those relationships is if somebody calls me at 5 o'clock, last night I got a phone call at 5 o'clock with a pre-approval, and they were trying to work on the numbers, and the customer wanted to make sure that he knew exactly what the numbers were. Well, I took the call, we got him comfortable with the numbers, and this morning I walked in and we have a purchase agreement. So having somebody willing to, work that deal at 5, 6 o'clock on a Sunday night, I should work as hard for your business as you are for your business. Yeah. So that's the way I look at it.
Yeah, our business is the same. Communication, availability, like those things are very important. And I think with our lender relationships, it's important to agents as well. So if you're going to think about the other side of this for agents, for them to build a stronger relationship with a lender, what does that look like, other side of the table?
Well, I think it's across the board. I mean, I think realtors, like it or not, they probably have more control over the situation. But if I looked at, if I was a realtor, what I would want, again, I would want somebody working as hard to put that deal together for my client as I am. You can't be a one-way street. It's got to be, if they're working on a Friday afternoon or Saturday afternoon or, Tuesday afternoon, I think there should be equal input across the board. And let's face it, not all customers are the 800 plus credit scores with 20% down. Mm-hmm. So I think, we've got a full breadth of products out there. It's, whether it's IFA loans, whether first-time buyer programs, every which way to put a deal together. I think as a realtor, they should be looking for a lender that marries their client base and is comfortable with, again, whether it's a $150,000 first-time home buyer or an $850,000 repeat buyer.
Yep. So one of the things we love about you, and I guess Tracy and Bobby as well, but you especially, obviously, one of the things is just your knowledge and just having a pulse on what's going on. So we want to make sure to talk to you about that. But as you look 2025 this year, think about market trends. What are you seeing as far as trends in the lending space?
Well, I'd say hot and cold is probably the best way I describe it, and that's of course the chicken answer. And I think
I'm going to ask you another question. You're going to give me a chicken answer on too. I'm sure.
I'm sure. I usually skirt the tough questions if I can, but no. I mean, I think at the beginning of the year I was all for seeing a 5 at the start of the rates. I thought for sure the spring market was going to have a 5 in it. I'm sure there's probably some video and or some recordings out there of that. I would never make a promise, but maybe that prediction. But I think that over the course of the last 3 months or 2 months, it's kind of taught me a little bit that the more I think I know, the less I know. But I think the market's kind of gone some ups and downs. I mean, we scooted up and we were probably dancing around the 7 range for a little bit. And we're starting to ease back down. I like the trend. I mean, today's been a really good day for rates. Last week we had some pretty good shining days. And then we head towards the end of the week, and we kind of bounce up a little bit. So nothing's going to be a straight line, but I think that overall, I would see between 6 and 6.5 would be a pretty large range, a little bit, but it gives me a little more breathing room. But I would say throughout this year, I don't see there's a lot of ambitions to stay over 6.5 or 7% range. I think it's going to be driving its way down, but you're probably going to see maybe a week or two of some hot numbers coming in, and we get some inflation numbers coming towards the end of this week. And those inflation numbers are just going to be, have hot spots. So you might, if you get a hot spot, you're going to have a jump up in rates. But I think the general trend you're going to see is probably downward throughout this year.
First 20 years I was in real estate, rates did nothing but go down. And so I just got used to it. And, people ask me what are rates going to do. I'm like, oh, they're pretty good right now. I mean, they may come down. I never dreamed they'd actually go up. I didn't know that was a thing. And then they did. And since then, it's like trying to predict what was going to happen just feels like no chance. I quit. I'm like, I have no idea. Don't know what they're going to happen or what's going to happen. But I think what would be nice is just like some stability. Oh. Even if that stability is around 6.25 or 6. Like I obviously love for that to be in the 5s that you promised, but but stability would go a long way because we got buyers out there who are like, are they going to be 7 this week or are they going to be 6?
Right.
So I think key for us moving forward would probably be stability. So we covered rates because that was going to be my next question is you have to tell me what rates are going to do this year. And so you were, you skirted around it well, but yes, we'll let you go on there. Any great products that you see for 2025 that you would really point agents to?
I when we were up in the 7s, the 2-1 buy down got a lot of traction. And I think the 2-1 buy down, and we can go into more detail on a 2-1 buy down and, more of a individual setting if anybody's got questions on it. But just in general, a 2-1 buy down basically just means that the seller buys the interest rate down for 2% for the first year, 1% for the second, and then it goes to standard after that. When it's in the 7s and you can buy it down 2% for the first year, and so now you're in the 5%, that becomes pretty attractive. So it's a great little kind of a tweak to do, as long as you kind of anticipate rates are going to come down, because nobody really wants payment shock when 2 years down the road, 3 years down the road, and all of a sudden you got a payment you can't afford. Yeah. So it's more geared for people that either anticipate some good pay increases over the next year or two, or if you're a gambler and you think and you believe what I just said as far as the rates coming down, I do think most economists do predict that the rates are going to come down.
You still have to be approved at whatever today's rate is, right, on that product.
Yeah, so you do have to be approved at the higher interest rate. It just gives you some breathing room for the next year, and then a little bit for the second year then. Yeah. So I would say that's probably the hot topic, I guess, that's been out there. With rates in the 6s now, so then you get into the 4s. And as long as everyone's aware that the honeymoon will come to an end at some point in time, I don't expect us to be a consistent 4% range in the next 2 years. I just don't foresee it.
Yeah, may never be, right?
Right.
Who knows? I certainly wouldn't plan on it, but you did promise us 5s, right. So we're going to hold you to that.
And this is recorded too, right?
Yeah, this is recorded. What advice would you give buyers and sellers thinking about buying or selling their house in the next year? What kind of advice are you giving?
The time to act is whenever you feel comfortable for it. So, the age old story of marry the house, date the rate. It holds true. I mean, we do have that program. It's a 5-year rate guarantee. So, for the next 5 years, if rates come down, we'll cover most of the costs of the closing cost. The only thing we require you to pay is the title work, which is anywhere from $700-800 or so. So it kind of softens the blow a little bit if we do have to refinance, and let's say you do lock in at the 6.5% rate, and we predict rates are going to go down. So my advice would be is if you've had the third kid and you're ready to move, pull the trigger and move. I do think that when we do see the fives, hopefully by the end of this year, because this will get thrown back at me, when we do, you're probably going to see some upward pressure on pricing, or on rates. And I'm sorry, I got to get my lingo straight, but on house prices. So you might if you wait till next year or towards the end of this year, because I did promise it. But then you get into the fives, and then all of a sudden that $300,000 house you wanted is now $310,000. So at the end of the day, did you save any money? Yes, you got the rate, and it makes it all pretty, but you also paid $10,000 more for the house. So I guess the time to act is whenever you see fit. And I thought about it a little bit, and I guess the other thing I would probably advise some realtors and or prospective clients, if you've got a bunch of buyers or a bunch of sellers that have houses, they were at 2% or 3%, that's the log jam we have right now. But run the numbers. So those people that we have the 2%, the 3% rates on, they've been in that rate for probably for 5 years maybe. And just in my experience, I did a lot of those loans at 15-year mortgages, right? So I was taking people from 30-year mortgages down to 15-year mortgages, and saving them money on a monthly basis, and or even up as far as that goes. So if they've been in their house for, let's say, since 2018-19 time period, and they refinanced, and so now they're sitting at a 2 or 3% rate, most likely they've got a ton of equity, because if I flip them to a 15-year, then they're chunking down that principal pretty good. And even though I think people's mindset is, I don't want to give up my 3% rate. Yeah, I get it. I don't want to give it up either. But if they truly looked at their mortgage balance, maybe their mortgage balance is only down to $100,000. And so they're holding on to that 2% rate. They only owe $100,000 on that thing, and obviously they're paying that down. They're going to have a ton of equity, because we all know that during that COVID years, they've got a lot of inflationary pressure, or a lot of inflationary monies that they've got that they could recoup. So maybe they could put $200,000-$400,000 down on their next house. And so yes, even though they're going up in rate, we're not talking huge money, because your available balance, I mean, the value you see in that 2%, 3% rate shrinks quite a bit when you only owe $100,000 or $50,000. So I'd say the first instinct I think a lot of people is that I don't want to touch the holy grail of the 3% rate. Peel that onion back a little bit further, kind of see what the true value of that 2% money is.
Yeah. That's a conversation we need to learn. You said it, but there is a log jam there. Like, if we could free that up a little bit, yep. I think it's going to be a good year anyway, but we could have an incredible year. So appreciate your time. Appreciate you, giving us your past there. And your past is pretty much all in lending, all in finance.
Yep.
But if you could have your dream job. So if you're not in finance, you're not in lending of any kind, so cars, houses, whatever, what would be your dream job?
I think I'm a guide for hunting at that point in time.
Oh,
I'm a big bow hunter, so I don't think I'm down with the Alaskan bear hunts or anything like that, but definitely whitetail hunts in Iowa, or okay. So I might be a guide at that point in time.
Do you? I know you got a cabin. You go up there, and is there any hunting up there, or is this just?
So the cabin's down at Sun Valley. So I've got my cousin's got some ground down around there. We do quite a bit of deer hunting, and I pretend that I'm a farmer, so I plant food plots and that kind of stuff.
Wow.
But I
Are you ready for the apocalypse or whatever that happens? I'm coming with you because I've never fired a gun or shot a bow or been hunting.
Well, I will tell you my Ford 9N tractor. It's I think it's a 1952. Just getting it started is a challenge all on its own. But
Well, I'll trail after you if we were ever in trouble. So.
Come on down.
Yeah, Matt, appreciate your time today, and appreciate New American Funding and our partnership there. If people want to get a hold of you, how would they find you?
If just reach out to me on a phone call or an email. My phone number is 515-490-4113, or matt.nolan@nafinc.com.
I appreciate you, Matt. Thank you.
Thanks a lot.